We are also given the depreciation expense for the year is understated with 120,000. So what are we required to do here? We are required to prepare an audit schedule for 8 columns with the following headings. 1, the original trial balance without adjustment. Roman 2, adjustment. Roman 3, the draft profit or loss item. Roman 4, the draft statement of financial position. Each section should have the debit and the credit column, and which is duly balanced. You can see this question is similar to the other one which we did, but you can see this question is having now some additional what? Some additional items. So what we basically we need to do here is we split our worksheet into 2, or Excel worksheet into 2. So basically this will be our solution. So this is an 8 column. This is an 8 column worksheet. And basically this 8 column worksheet we are required, or we are given the sections to be included. The sections to be included here. So automatically we are going to start with the details column. We will start with the details column. Then from there, we can have the original trial balance, because I hope you can remember we are given the sections to be included here. The first one should be the original trial balance. Maybe I can just copy this one. The original trial balance. Let me just copy this one. Original trial balance. Maybe I can have that from here. That is the original trial balance. So, and then in this case, in the original trial balance, remember, we need to have 2 columns in each section, the debit and the credit column. Then we will have the other section, which is basically the adjustment column. And in this case, we will equally have the debit and the credit column like that. And then from there, we will have the statement of profit or loss. Statement of profit or loss. And then finally, remember also here we need to have 2 columns, the debit and credit. And finally, we will have the statement of financial position, which was formerly known as the balance sheet. Equally here, we need to have 2 columns like that. And then I hope you can also see the figures we're given here are in thousands of shillings. So we equally up there, we need to indicate all our figures will be thousands of shillings. So I need to copy this one. I'll copy that and basically paste that across. So paste, Control V, yes, like that. Then I think I need to split this. This will be our original trial balance. The adjustment section, our statement of profit or loss, and finally, we have the statement of financial position, like that. So maybe we can make this one a little bit, we can expand this. Yes, so I think now we can move, and basically we start by preparing the original trial balance. So how do we prepare the original trial balance? We prepare the original trial balance basically from the balances which we have here. From these balances which we have here, these are the balances we use to prepare the original trial balance. So what we need to do, first of all, I'll pick these particular balances, or I pick these particular items, not balances, all these items, all of them. I'll copy them. I copy them and then I transfer them here, basically from here. I paste them here, Control V. Okay. Let me copy them afresh. Control C. And then I need to paste them here, Control V, like that. Yes, Control V. Now, basically what I need to do is to bring these particular items, or actually, you can see these balances which are given here. They are not arranged within our trial balance. But I think I said that once you're given a number of balances, you need to know each item, each of these balances will go to which side of the original trial balance. Will it go to the debit or the credit side of what? Of the trial balance. And I think there is something I gave you yesterday. There is a certain acronym I gave you yesterday, and the acronym is what? Is DIDA. The acronym is DIDA, D for drawings, that is capital D for drawings, and then E for expenses, A for assets. We said all these items in the trial balance, they have a debit balance. That is the first thing. So these are questions on compound financial instruments, which basically falls under the topic of financial instrument, CFI. CFI in full, this what? The compound financial instrument. Now, maybe just a quick recap, even before you go on that question. We say that compound financial instrument, basically, these are the financial instruments which contains both the equity and liability component. And actually, we said good examples of these are the convertible securities. Convertible securities issued by the company, like the convertible debentures, the convertible bonds, the convertible own stock, and so on. All those are good examples of compound financial instruments. So therefore, these financial instruments, we say they contain the liability, and also the equity component. The equity component. We have said good examples of this. Examples of this include something like the convertible debentures. The convertible debentures. And therefore, what we say is that once you come across a question from this topic, and specifically you're told a company has issued a compound financial instrument, like the convertible debentures, the convertible bonds, and so on, the first thing you need to remember very fast is that that is what? A compound financial instrument. Why do we say that these financial instruments which are convertible, they contain liability and the equity component? Number one, we say they contain the liability component simply because the issuer, the company which issued these convertible debentures, has an obligation. The issuer has an obligation to pay cash. Has an obligation to pay cash, and the cash to be paid here is in form of interest and also in form of what? A principal amount. Like in this case, we say, if, for example, company X has issued convertible debentures, this company has to pay the interest on annual basis, and once these particular debentures mature, the company has to redeem them in terms of paying back the principal amount. So therefore, we say that this obligation to pay cash in form of interest, in form of principal amount, that obligation is basically a liability. Is what? A liability, because we know from definition, liability is an obligation to pay. Is an obligation to pay cash. On the other hand, we say that these convertible securities contain the equity component simply because the holder basically has a right. The holder has a right to convert them into the ordinary shares. To convert them into ordinary shares. In other terms, what that means is that once you have invested in convertible debentures, you have a right to convert them into ordinary shares. That right which you have to receive the ordinary shares of the company, that is called an equity. That's why we say any convertible security basically contains the liability and the equity component. Basically, what we say is that once a company has issued this compound financial instrument, the two components, the liability and the equity component, should be splitted. So we talked about two steps to be followed here. Step number one, we said we compute the liability component. How do we compute this one? We compute this by discounting two items, by getting the present value of two items. The present value of the annual interest to be paid and the present value of the principal amount. So that gives us the liability component. Step two, we proceed and we compute what? The equity component. So the equity component, we say that this is equal to the difference between the sales proceeds. Sales proceeds basically the amount of money which the company received after issuing those compound financial instruments minus the present value, of, or actually minus the what? Minus the value of the liability component. The value of the liability what? Component. So therefore, that's basically how we split the two parts, the liability component and the equity component. So let's just go straight to that particular question. We will be able to understand more how we do the split, how we split the two components, the equity component and basically the liability component. I've already shared that question, that small question, which I want us to do in the class WhatsApp group there. In the class WhatsApp group. So what are we required, or what are we told here? So the question reads, a good limited issued shillings 4,007,000 convertible bonds on 1st of January 2019 at par value. So the bond is redeemable at par on 31st of December 2023, or can be converted at that date on the basis of 2 shillings 1 ordinary shares for every shillings 10 of the bonds held. And then you're told the prevailing market interest rate on 1st January 2019 for similar bonds without conversion rates was 9% per annum. And then you're told all the interest due in the year which ended 31st of December 2019 have been paid. So what we are required to do basically is we compute the amount to be included in the statement of financial position for Good Limited in respect of the convertible bonds on 31st of December 2019. I think what you're going to do, we will change that particular requirement, and basically what we will do, we will prepare the financial statement extract of this company basically for how many years? For I think 4 years, because these bonds they have right for 4 years. I think 4 years. We have the first year which ended 2020, 2021, 2023. So they have a life of 3 years, because if you check in paragraph 1, sentence 2, they will be redeemed at the end of 2023. They were issued on 1st January 2019. So basically they have a life of 3 years. So what we will do, we will prepare financial statement extract for how many years? For 3 years. So now say this is a question from the paper for financial statement analysis. This is a paper which is basically done in CIFA. And specifically, this was a question from the sitting of November 2020. Question number 5A. Question 5A. So the first thing, and maybe we can even mention here before we proceed to prepare financial statement extract, is that these convertible bonds which were issued by our company, this is a compound financial instrument. It's a compound financial instrument. So we can say that the 7% convertible bonds issued by Good Limited, is a compound financial instrument, is a CFI. It basically contains both equity and liability component. Therefore, what we say is that once a company has issued such a compound financial instrument, on the date of the issue, the company should split the two components, the liability component and the equity component. So we need to follow the 2 steps. So we need to start by computing the liability component, because we say that is step 1. We compute the liability component. So this liability component is basically computed on the date of the issue, or actually we do the split on the date of the issue. That's when we do the split. So if you check on the date these bonds were issued, they were issued on 1st of January 2019. 1st January 2019. That is the date we need to compute the liability component and the equity component. So how do we compute this one? This one is equal to the present value of the annual interest plus the present value of the principal amount. The principal amount is the amount to be paid on redemption. So let's start by computing this one, the interest to be paid annually, the interest per annum. And we say this one is computed by taking the coupon rate. We say these formulas are very, very important. The coupon rate times the par value. The par value can also be known as the nominal value. It can also be known as the face value of this compound financial instrument. And in this case, we said that always in these questions will be given 2 rates. Like if you check, we have this rate of 7%, this one. And then in paragraph 2, we have another rate of 9%. So we say this rate, which are given before the name of the compound financial instrument, this one is the one, this is the coupon interest rate, So therefore, the interest will be paid annually and will be based on the coupon rate. This is the coupon rate, 7%. And then you multiply that with the par, the nominal or the face value. That is given within paragraph 1, because we are told Good Limited issued shillings 4 million, 7% bonds on 1st January 2019 at par. So the company issued bonds which had a value of 4 million, and you're told that 4 million is the par value. The par value, I've said, can also be known as the nominal or the face value. So this will give us the interest per annum. So the interest per annum here will be shillings 280,000. So this is what the company will be expected to pay per annum. And then from there, we can proceed and basically determine what will be the principal amount. The principal amount in this case, we said, is the amount payable on redemption. Amount payable on what? On redemption. And in this case, I say the amount to be paid on redemption is always equal to the par value unless sold otherwise. So we say that this one is equal to the par value, or basically the nominal or the face value, unless told otherwise. Unless stated what? Otherwise. Unless stated otherwise. Unless stated otherwise. So I think there is some information which is given in relation to this within paragraph 1, sentence 2. So we are told the bond is redeemable at par. The bond is redeemable at par. So the par value of the bond is what? Is 4 million. So when the company is redeeming them, the amount to be paid will be how much? Will be 4 million. Will be 4 million. So having those two values, the annual interest and the principal amount, we need to discount them, and we get the liability component on the date of the issue. So in this case, we can just have a procedure here for discounting this. So remember, they were issued on 1st January 2019. When will they be redeemed? They will be redeemed at the end of 2023. So how many years do we have between those two dates? 1st January 2019, 31st of December 2023. How many years do we have here? The first year will end 31st of December 2019, actually, 2019. The other one 2020, the other one 2021, 2023. Are those 4 years? They are 5, eh? Yes, because we have 2019, 2020, 2021, 2022, 2023. 1, 2, 3, 4, 5. Yes. So basically there are 5 years. Are they 5 years? Please? Are they 5 years? Diana, Georgina, are you getting 5 years? 2019, 2020, 2021, 2022, 2025. Yes, we have 5 years. So meaning that we will have 5 years here. Year 1, year 2, year 3, year 4, year what? Year 5. And then here we can have the cash flows. Basically, cash flows is what our company will pay. We can just refer to them as cash flows. So in the first year, remember, at the end of each year here, our company will be paying interest of 280,000. 280,000, 280,000, 280,000. But now at the end of year 5 here, the company will pay 280, plus the company will have to redeem them by paying back 4 million. That's basically what you need to know. That's what you need to know. Yes. So here we will have 280,000, 280, 280,000, 280, 280, and then in the last year here we will have 280 plus 4 million, which will give us 4 million and 280,000 and 280,000. And then what we need to do is to discount this by multiplying that with the present value interest factor. And actually we say here we use the effective interest rate. For discounting, we use the effective interest rate. The effective interest rate is what we have within paragraph 2. The effective interest rate is what? In paragraph 2, 9%. That is basically the rate which you use for discounting, 9%. 9%. And then we will get the present what? The present value. So first of all, give me those values there. The present value interest factor. So remember here, which formula do we use? We use this 1 plus R raised to power negative N raised to power negative 1. So it should be 1.1 in year 1. You raise that to negative 1. In year 2 is 1.1 raised to power negative 2. In year 3, 1.1 raised to power negative 3, and so on up to the last year. So in the last year we have 0.9174. Yes, year 2, what do we have? Year 2, what do we get in year 2? You try to hurry up because of time. Yes, what are you getting in year 2? Yes, alternatively, you can use 𝐕𝐎. Basically, remember I say that there are different approaches of discounting this. There are different approaches of discounting this. If you feel that this one is quite wrong, let's first of all finish this one, and then I show you another approach. I show you another approach of doing it. Another approach of doing it. So I'm waiting for this present value interest factors. For year 2, it will be 1.1. Yes, year 2 is 0.84, 84.17, 77.22. Year 4, 70, 84. And year 5, what do we get here? 64, 99. Yes, so then you take these values, you multiply them, you get these present values, and then you give me the total here. Just give me the total there. Just give me the total. Just give me the total. So you can do that. Alternative release is asking, can we use another approach? Yes, there is still another approach, because now these 280 are annuities. Are annuities, you can just take 280 times 𝐕𝐎. 𝐕𝐎, the present value interest factor of annuity, at the rate of 9%, at the rate of 9%, and basically for 5 years. For 5 years. So you compute this, then you add the present value of this, 4 million. You take 4 million, you multiply that with the present value interest factor. This is not an annuity, at the rate of 9%, basically at the end of 5 years. You can still use that approach. You can still use that approach. You'll get the same value by the end of the day. You'll get the same value, the same value by the end of the day. So you can use either of the approach. The one maybe you feel is simple for you. So you can use either of the approach. Yes. So now what do we have here? What do we have here? So whatever we have computed here is the liability component on this date. The liability component. This is the liability component. The liability component on 1st January 2019. That is the liability component. So having computed the liability component, step 2, we need to proceed and we compute the equity component. The equity component still on 1st January 2019. How do we compute this equity component? We take the sales proceed. The sales proceed is basically the amount which was received by the company from the issue. Once the company issued these 7% convertible bonds, how much amount was received? Now, in paragraph 1, we are told they were issued at par. They were issued at par of 1 million. Not 1 million, they were issued at par of how much? Of 4 million. So this is the amount which was received. The amount which was received by the company was 4 million. So to this, we less the liability component on the same date. We less the liability component still on that date, 1st January 2019, which we have computed here. That is 36, 88, 828. So the difference here will be the equity component on 1st of January 2019. And this should give us 100 and something. Oh, sorry, not 100. Not 100. That is the 300, 172, 172. So that is basically the what? That is the equity component, the equity component. Now, basically what we say is that this equity component, the value for the equity component, this one does not change. Over the 5 years, this one will not do what? This one will not change. But this one, we have to amortize it. So what I want us to do, I want us first of all, we amortize this so that then we can proceed and we prepare financial statements extra. So let's amortize our liability component. And we amortize this one by preparing the amortization schedule. By preparing the amortization schedule. So here we need to have 5 years, year 1, year 2, year 3, 4, 5. Remember, this is a year now which added 2019, 2020, 2021, 2022, 2023. And then the next column here will be the liability at the start of the year. The liability at the start of the year. The next column here will be for the interest. And remember, this now will be an interest expense. So because our company has issued the bond, so this one will be recognized in the income statement as an expense. Now, this one, you also have to recall, we computed based on the effective interest rate, not the coupon rate. We compute this based on the effective interest rate, which is basically 9%. And then we have a column here for the cash to be paid by our company. And finally, the liability at the end of the year. The liability at the end of the year. So those are basically the columns we should have here. So what we start with here is the liability at the start of the year 1. Liability at the start of year 1, what we have computed here, because this is the amount we want to amortize. To amortize, we said, is to gradually write off the liability. So at the end of year 5, the value for this liability should be 0 because it represents, or this liability represents what the company will pay for the next 5 years. At the end of the 5th year, the value for that liability should be 0. So it is basically 36, 88, 828. So we compute the interest, which will be 9% of this. The interest, which will be 9% of that, which will be 331, 995, 995. That is the interest expense. Then we already have the cash to be paid. The cash to be paid is what we have here. This is what our company will pay for the next 5 years. So in fact, we can have those figures here to 80,000, then to 80,000. Year 3, the company still will pay to 80,000. Year 4, the company will pay to 80,000. And year 5, the company will pay 4,280,000. That is basically the cash to be paid. And this cash to be paid will basically reduce the liability. So meaning, to compute the liability at the end of the year, we take the liability at the start plus interest minus what was paid. So we get the liability at the end of each year. So the liability at the end of year 1 will be what? This plus this minus 280. Minus 280, which will give us 3740, 823. 823. So how have we computed that? The liability at the start plus interest minus what was paid. Now, the liability at the end of year 1 will be the opening balance here, which is 740, 823. So what we need to do is basically proceed and compute what? We compute the interest. So what will be the interest? 9% of this. 9% of that, I'm told, is 336. As 336, 674. And then you compute the liability at the end of year 2, which will be equal to this plus this minus that. That will give us 37, 97, 497. 497. That will be the opening balance here. That is 797, 497. So how much interest will be paid in year 3? How much interest? 341. 341,775. Yes, and the liability now at the end of that year. The liability. The liability will be 38, 50, 9, 272. Yes, so that will be the opening balance at the start of year 4. 38, 59, 272. What about the interest? The interest, I'm told 347. 347, 3 what? 337. 337. The liability at the end of that year. The liability at the end of that year. The liability 3926. 3926. 606. Yes, that will be the opening balance here, 3926. 606. And the interest. The interest 353. 353. 395. 395. And then we compute the liability at the end of year 5. The liability at the end of year 5. This one should be 0, but you may get a figure which is insignificant. I'm told the figure there is 1, but essentially that one should be 0. The reason why we are getting 1 is because of the aspect of what? Rounding off. Now, having that, what then do we need to do? We need to prepare the financial statement extract, because we say mostly the question will come across at your level is whether you're required to prepare financial statement extract. You show what was supposed to be accounted for in the income statement, or what was supposed to be recognized in the income statement as far as these compound financial instruments are concerned, and what was supposed to be recognized in what? The statement of financial position. So let's start by preparing the statement of profit or loss. Profit or loss. Remember, this is basically an extract. An extract, we say, is part of something, is part of the statement of profit or loss. We are preparing this for 5 years. Remember, now we can have the specific dates. The first year ended 31st of December, 2019. The other one, 31st of December, 2020. The other one, 31st of December, 2021. 31st of December, 2022. 31st of December, 2023. 2023. Now, what is supposed to be recognized in the income statement of this company? Just one item. This particular interest expense will be recognized here as what? As an expense. Was supposed to be recognized here as an expense. Other expenses. So this interest expense should be recognized there. In other terms, you can just say that this one will be a finance cost. Will be a finance cost, because that one will be included within what? The finance cost. So the finance cost for the first year is 331,995. Year 2, 336, 674. That is year 2. Year 3, 341, 775, 775. Year 4, 347, 337, and year 5, 353, 395. So this is what was supposed to be recognized in the income statement of this company. What about the statement of financial position? In the statement of financial position, we say 2 items. One, we have the liability component, this one, which should be recognized as a liability here. And then number 2, we have the equity component. The equity component. So this is a statement of financial position extract. So basically, we equally need to prepare this for how many years? For 5 years. 2020, 31st of December 2021, 31st of December 2022, 31st of December 2023. 2023. So 2 items to be recognized here. One, at the equity. At the equity, our company will recognize this particular component here, the equity component. And you have said that the value for this equity component will not change over the period of 5 years. So under the equity, the company will have something called the equity component. Equity component of what? equity component of 10% convertible bonds. Over 10% convertible bonds of 10% convertible bonds. So that would be 311, 172, and actually that will not change over the period of 5 years. 311, 172, 311, 172, 172, and then under the liabilities, or basically under the non-current liabilities, under the non-current liabilities. So the company will recognize something called the liability component, a component of, was this 10% or 7? I think this one was 7%. 7%. 7%. Yes, 7 over convertible bonds. 7% convertible bonds. So the liability component at the end of year 1 is what we have here, this value here. That is 3740, 823. Then 2020, this one, 37, 97. For what? For 97, year 3, we have 3859 to 72. And then here we have 3926, 606, and then there is what? Is 0. There is 0. There is what? Is 0. Is 0. Is 0. Yes. So that is it. That basically what was required there. That what was required there. Yes, so therefore, if you happen to come across such a question on a CFI compound financial instrument, I think that what you need to remember that the two components, the liability and the equity component, must be splitted, and then the liability component to be amortized. But you have seen that the value for the equity component remain the same, remain the same. Yes, so that is it. I'm trying to look for a different question, maybe. Why haven't we calculated the value for the liability, for the current liability? So I think in case of a financial instrument, we don't do that like what we are doing under leases. I think I'd mentioned that when we were looking on this. So this liability component, we don't have to split it like what we are doing under leases. So remember under leases, this liability, we were splitting it as non-current and also current. But in this case, that is not a requirement. That is not a requirement under this standard. Under this what? Standard there. Sasa, yes. Now, there is a question which is here, but basically similar to a question which was I think I'd given you this question as an assignment. It was a question from a FAL, but I hope we never did that question in class. And we do that question, or we can just get another one, because this one is basically similar to what we did in class. So we don't have so many questions on this. Remember, this is a new standard. This is a new standard. IFRS 16 is basically a new standard. So we don't have so many questions which are which have been tested in accordance with the IFRS 16. IFRS 16, we don't have so many questions on this, because I think we were able to do all the questions from your past papers on rhesus. Maybe what I'll do, I'll just get a question for just revision. Let's just use this question from a part, although even if it is similar to the other which we did in class. So let me share this in the class without group. Let me share that in the class without group. Yes, so check the question which I've shared here in the class without group. So if you see it, please confirm. Have you seen the question? Okay. Rhesus. Remember, we say that this is currently are accounted for in accordance with IFRS 16. Previously, rhesus were accounted for in accordance with the International Accounting Standard number 17. But basically, we said that standard was scrapped. Currently, rhesus should be accounted for in accordance with International Financial Reporting Standard number number 16. And actually, we said as per that particular standard, whenever the owner of the asset basically leases out an asset which he owns, the first thing he needs to do, even before he proceeds to account for this, is to determine whether the risk is a finance or an operating risk. So we said for the accounting purpose, the owner of the asset, who is also called the lessor, should classify the risk as a finance or operating risk. And we're able to look on how the operating risks are accounted for, and also the finance risks are accounted for. But now the person who has been given the right to use the asset, who is called the lessee, we said he should not do what? He should not classify the risk as a finance or an operating risk. That classification of the risk as operating or finance is only applied to the lessor, the owner of the asset. Now, what we say the lessee should do is to recognize two items: the risk liability, the right of use asset. If you lease an asset, recognize two items: the risk liability, the right of two assets. But also recall, we talked about two exemptions whereby the lessee, or actually we talked about two circumstances whereby the lessee is exempted from recognizing those two items. You can lease an asset, but basically you're not required to recognize a risk liability and the right of use what? Asset. Which are those two circumstances, or which are those two instances? One is whereby you have leased an asset which is regarded to be of low value. You have leased an asset which is regarded to be of low value, like maybe a personal computer or maybe an old car. Number two is whereby you lease an asset for a short period of time, or basically you lease an asset under the arrangement of a short-term lease. A short-term lease. A short-term lease is basically a lease whose lease term is 1 year or less. 1 year or good or less. Okay, so let's look on that question. And basically, this is a question from the paper for a 𝐼𝐍 intermediate level. Specifically, this is the question for what? For August. We will do that question a little bit fast because it is basically similar to another question which we did in your paper for a 𝐼𝐍. But let's just do it as part of our revision. So what are we told? We are told on 1st January 2019 Breakwood Limited entered into a contract to lease. So we did this one. Okay, if we did it, no need of repeating it. Do we need to repeat it? So if we did this one, do we need to repeat that? I don't think so. I don't think so. I don't think there is need of repeating it. I don't think there is need of repeating it. No need, no need, no need. Okay, then we do this. We take a short break of 5 minutes. I'll try to get another question and share it with you, and then we do it after break. So let's just do, we take a short break of 5 minutes. We come back. Yes, so I think we can proceed. Let's continue. So there is, I've shared 2 questions with you here. There is a question on sales leaseback, and also another question on, I think, accounting for leases. So I want us to do that one for sales leaseback. Let's do the question for sales leaseback. I think that is maybe the concept which was a little bit technical. And I hope you can see that question. Hopefully it's not similar to the other one we did. Is this one similar to the other question we did in class? I hope not. I hope it is not similar to the other question we did in class. Yes, it is not. It is not. It is not. So let's go to that question for the sales with leaseback. The question for Wingstone Limited. Wingstone Limited. Are you there? Wingstone Limited. Wingstone Limited. If you are there, please confirm. Wingstone Limited. Wingstone Limited. So this is a question which was examined in November 2018 from the paper for FSA, Financial Statement Analysis. This is the CIFA. Specifically, this is a question number 3, C. Question 3C. So it's a question on sales leaseback. Remember, I said a sales leaseback. Just a quick recap. We said that this whereby the owner of the asset basically sell that asset, or a company sell an asset and immediately lease back the asset. So meaning that the company which owns the asset and basically selling that asset, that company is called the seller, and basically sell that particular asset to another company which would be known as the buyer. But after the asset is sold, we say that this company here will basically lease back the asset immediately. So we have a sale here of the asset being sold, and then we have a lease. We have a lease contract. So, and because this company has bought the asset, meaning that it is the owner of the asset, it is the one which is leasing out that asset. This company is also known as the lessor. So therefore, we say the first party in a sales leaseback transaction is the buyer lessor. Is the buyer lessor. And then this company here, because it has leased back the asset, this company is also known as the lessee. So therefore, in a sales leaseback transaction, we say that we have 2 parties. We have the buyer lessor, and also we have the seller lessee. Now, what is saying for us to be able to account for this particular transaction here, or this sales leaseback transaction, we basically need to determine whether this sale here basically amount to a true sale. So whether this sale is a true sale, or basically whether this amount to a true sale or not. And actually, we say that this will amount to be a true sale if basically it satisfies the requirement of IFRS 15. So this transaction shall be deemed to be a true sale if it satisfies the requirement of IFRS 15. Basically, we say it will be this transaction will be a true sale if the control of the asset is basically transferred to this party, and number 2, the rewards and also the risk associated with the asset are transferred to who? To the buyer. But if you check on that particular question there, I think in the last paragraph we are told the transaction satisfies the requirement of IFRS 15, the revenue from contract with customer. So basically what that means is that this is a true sale. is a true sale. So we said if then the transaction is a true sale, what happens is that this party here, the seller resaw, the seller receive, not resaw, the seller receive. Number one, we need to recognize the asset. He need to recognize the asset. So to recognize the asset, he need to remove that asset from his books of account. He need to recognize that asset. Number two, he need to recognize something called the profit or loss on sale. The profit or loss on what? On sale. And I think we looked on how we compute that. This party also here will need to recognize something called the right of use asset because he's leasing back that particular what? Asset. And number four, he also need to recognize something called the lease liability. That's basically what we say. So if the transaction amount to a true sale, this party should recognize the asset, recognize the profit or loss on the sale, recognize the right of use asset, and recognize the right, there is what? Liability. And actually, we said what you need to remember here is specifically how we compute these two items. How do we compute the profit or the gain or loss on sale? And how do we compute the right of use asset? There are two formulas which I gave you, which we agree that you must be able to remember those two formulas. In terms of how we compute this one, the lease liability, we say this one is quite simple. This one is always equal to the present value of the lease payment. The present value of the lease what? Payment. So, but how do we compute this one? First of all, the right of use asset. Can you be able to remember that formula of computing the right of use asset? We said we take what? We take the previous carrying amount, or basically the net book value of the asset, and then you multiply this with what? You can be able to remember that very fast. We multiply this with what? The previous carrying amount of the net book value of the asset times what? Times what? Times what? Who can be able to remember this phase? Gilbert. Yes, times what? And the present value of the lease payment all over the fair value of the asset. The fair value of the asset, we said, is the same with the sales what? Proceeds. Is the same with the sales what? Proceeds. What about this one? How do we compute this one? The profit or the loss on a sale. So we said we compute the normal gain or basically loss. The normal gain or loss, this one is computed by taking the sales proceeds minus the net book value or the carrying amount of the asset. And basically, we multiply this with what? Who can be able to remember? We multiply this with what? We multiply that with what? The normal gain or the normal loss. We multiply that with what? Yes, we multiply this with what? With basically, here the denominator should be the fair value or the sales profit, just like here. And then we also take here the fair value minus the present value of the lease payment. Those are the two formulas which we say that are very important as far as the sales leaseback transaction is concerned. So if you can be able to remember that, then the question becomes simple. And then we say, if this transaction is a true sale, now the buyer SO will actually account for that particular transaction, or actually will account for that lease as either operating or finance. So let's go to this question and see what we are told. So we are told that Winston Limited bought a drilling machine for shilling 7.2. That is the cost, 7.2 million on 1st April 2016. The machine had an estimated economic useful life of 6 years on that date, and a straight line depreciation to a nil residue value was provided. And then you're told on 1st of April 2017, Winston Limited sold the machine to 𝐻𝐻 Limited for shillings 8.88 million at its fair value. That is basically the selling price for the fair value. And then you're told Winston Limited immediately leased back the machine from 𝐻𝐻 Limited for 5 years, the remainder of its useful life at rental of 1.92 million per annum, payable in arrears. The present value of the annual lease rentals at the inception date of the leaseback amounted to 8.4 million, at the implicit interest rate of 4.625%. The transaction satisfies IFRS 15 revenue from contract with customers. So what are we required to do here? Roman 1, we're required to compute the amount of gain that Wingstone Limited should recognize for the year which ended 31st of March 2018 in respect of the sales leaseback. Roman 2, we're required to prepare extract of financial statements of Wingstone Limited for the year which ended 31st of March 2018 to account for the right of use asset and there is liability. And there is what? Liability. A very good question on sales leaseback. Sales leaseback. So what we are told is that the company which is called Wingstone Limited. So this particular company bought a machine at 7.2 on 1st April 2016. And then let's go to paragraph 2. In paragraph 2, we are told on 1st of April 2017, Wingstone Limited sold the machine. So this company is the owner. It sold the machine to the company which is called 𝐻𝐶 Limited for 8.88 million. And then in the other paragraph, we are told Wingstone Limited immediately leased back the machine from 𝐻𝐶. It basically means that this company here, this will be the buyer, not buyer, sorry. This company will be the seller, lessee. So this company sold the machine and immediately leased back the machine. This company here will be the buyer, lessor. Will be the buyer what? Lessor. And now what we are told is that this transaction basically satisfies the requirement of IFRS 15. So it basically means that this transaction is a true sale. This transaction is what? Is a true sale. Is a true what? A sale is a true sale simply because it satisfies the requirements of IFRS what? 15. So if that is the case, then we have said that this company here will need to recognize that asset. Number 2, recognize the profit or the loss on disposal. And number 3, recognize the right of use asset. And there is what? Liability. So what we are required in Roman 1 of the question is we compute the amount of gain, to be recognized, by who? To be recognized by Wingstone. To be recognized by Wingstone Limited. To be recognized by Wingstone Limited. Wingstone Limited. Remember, Wingstone Limited is the seller, lessee. Is the seller, lessee. So you just need to remember that formula which we had up here. So how do we compute this gain or the loss on disposal to be recognized? So the gain, or basically the loss on sale, or basically the disposal, to be recognized, we have said is equal to the normal gain stroke loss. But automatically in our case here, we will have a gain. We will have a gain, and then we multiply this with what? With the, we have said we multiply this with what? With the present value of the lease payment, the present value of the lease payment. Okay. Is it the present value? No. This one should be the fair value. The fair value of basically the sales profit minus the present value of the lease what? Of the lease payment, divided that with the fair value or the sales what? The sales profit. The sales what? The sales profit. The sales profit. So that's basically what you need to remember here. So we need to compute the normal gain or loss The normal gain or loss, this one is equal to the sales profit. The asset was sold at how much? Minus the net book value, or basically what? The carrying amount. I think there is something which you're not given here, the net book value of that asset. We're not given the net book value or the carrying amount. We need to compute this. How do we compute the net book value? Or how do we compute the carrying amount of an asset? So this one is computed by taking the cost of the asset minus the accumulated depreciation. We're going to use the information within paragraph 1. The information within paragraph 1, because we are told that this machine was bought by our company, that is Winston Limited, at 7.2 million. 7.2 million. That is a cost. That is a cost. We less the accumulated depreciation. So the accumulated depreciation, we are told it was bought on 1st April of 2016. So it is important for you to note that we are computing this net book value at the time the machine was sold. So when was the machine sold? As per paragraph 2, the machine was sold on 1st of April 2017. This is when the sale took place. But when was it bought? It was bought as per paragraph 1 on 1st of April 2016. So mean that this machine just was used for 1 year. Was used for 1 year. So therefore, we need to compute depreciation for 1 year, which will be equal to the cost. Remember, we are told in paragraph 1, sentence 2, the machine had estimated economic useful life for 6 years. A straight chain method is to be used, and a nil residual value. So the depreciation per annum will be equal to the cost minus the scrap value, which is 0. We divide that with what? With 6. So that will give us depreciation for 1 year. Depreciation for 1 year. So at the time it was sold, it had a net book value of what? Of 6 million. It had a net book value of 6 million. So having that, then we can be able to proceed and we compute this. The normal good. The normal gain. The normal gain will be equal to the selling price. In paragraph 2, we are told this asset was sold for 8,880,000. So that is the selling price minus the carrying amount of the net book value, which is 6 million. So in this case, you can see the asset was sold at a profit of 2,880,000. We need to multiply that with whatever you have here, times the fair value. Remember, the fair value you have said is the same with what? The sales profit. 8.88 million. That is the fair value of the sales profit minus this one, the present value of the lease payment. And that one is given within paragraph 3. Within paragraph 3, the last sentence, we are told the present value of the annual lease payment at the inception of the lease back amounted to 8.4. So this one is 8.4 million. 8.4 what? Million, 8.4 million. And then we divide that with the fair value. The fair value of the sales proceeds is 8.88 million. So this will give us the profit to be recognized by this company. The profit to be recognized by our company. So how much profit will be recognized by our company here? How much profit will be recognized by our company? How much profit will be recognized by our company? Our company will recognize a profit of how much? Our company will recognize a profit of how much? I'm given a figure of 155. Someone to confirm this. 155, 676. Is that the amount you're getting? Is that the amount you're getting? Is that the amount you're getting? Please confirm. Is that the amount you're getting? Yes, that is confirmed by Janet. So that basically what was required here in Roman 1, the amount of profit to be recognized by who? By Winston. By Winston. By Winston. So then Roman 2, Roman 3 of the question, Roman 3, we are required to prepare extracts of financial statements of 𝐉𝐻 Limited for the year which ended 31st of March 2018. 31st of March of 2018. So basically, this should be the end of the first year, because I hope you can see this asset was actually sold on this date. So mean that this year will end on 31st of March 2018. So we are required to prepare extract of financial statement of which company? Of automatically this company. Yes, this company here, because this is a company to recognize the right of use asset and basically what, and actually the risk liability. Now, even before you do that, the first thing we need to do here is basically to compute one, the right of use asset. We need to compute the right of use asset. We basically depreciate that. And then number two, we already have the risk liability. What we will do is just to prepare the amortization schedule. So let's do this first of all. We compute the amount of the right of use asset. What will be the value for the right of use asset? And this will help us in terms of answering Roman 2, whereby we are required to prepare extract of financial statements for 𝐉𝐻 Limited for the year which ended 31st of March 2018. 31st of March 2018. So we need to, first of all, to compute the right of use asset. The right of use asset. So the right of use asset. How do we compute this one? We take the previous carrying amount or the previous net book value. So before the asset was sold, what was its net book value? We multiply that with what? We multiply that with the present value of the risk payment, divided that with the fair value, or the sales what? Proceed, or the sales proceed. That's basically how we compute the rate of use asset. So the previous carrying amount, or before the asset was sold, its carrying amount is what you have computed here. It was 6 million. 6 million. We multiply that with the present value of the risk payment. Present value of the risk payment is 8.4 million, divided that with the fair value of the asset, which is the same with the sales proceeds, 8.88 million. And that will give us a value of how much? I'm told that will give us a value of 5,056,75. 676. Is that what you are getting? Are you getting the same value? Are you getting the same value? Yes. So that is the value. Now, what we need to do is basically to depreciate this on a straight line. We depreciate this on straight line. And then from there, we prepare the risk amortization to amortize this one. But even before we do that, can you be able to remember the accounting entries which we made? Because in this case, we said you can be required to show the accounting entries in the books of account of this company on the date the transaction took place, on the date this sales leaseback took place. That is on 1st of April 2017. So maybe just to remind ourselves the accounting entries to be made, because we have a number of accounting entries here. A number of accounting entries. One, we say that this company, that is 𝐉𝐻, on this date, it sold the asset and basically leased back the asset. One, it will recognize something called the right of use asset. This is an asset account. Being an asset account, it will be debited. So this account will be debited with 675. Still, this company will do what? It will debit the bank account because it sold the asset. So it will debit the bank account with the sales proceed. How much amount was received from the sale of the asset? This amount here, 8,880,000. So that is basically the other account to be debited. After debiting that, our company here will credit, I think, three accounts. The first one is the statement over profit or loss with a gain, which you have computed here. Where do we have that gain? This one, 155,676. The other account to be credited is what? Is the asset account. Which was this asset? This was machine. The machine account. The machine account, because the asset was sold. So the account will be credited to recognize the asset. So it will be credited at the net book value. The net book value is for 6 million here. Or 6 what? Million. And then still we credit something called the risk liability. The risk liability with what? With the amount which you have computed here. 56.75. Huh? No, that is the right of use asset. Okay, the risk liability is this one. Which is 8.4. 8.4. And actually we said if you add this and this one, will they be the same? I think no. The risk liability is 8.4. Right of use asset, yeah, this one should be 6. This one should be 6. So they should be the same. Whatever you have debited, whatever you have credited should be the same. Is that coming to the same value? Is it coming to the same? Yes. If you add this and this, this and this, whatever is debited should be equal to what you have credited, this plus that. I hope it is coming to the same value. Are you getting the same value? The same value? Yes, yes. So now, is that what was required? No. What we are required to do is basically we prepare financial statement extract of Wingstone for the first year. So we will show 2 items. Well, actually, we will prepare income statement extract whereby we are going to recognize 2 items: depreciation on the right of use asset, and number 2, the interest on the lease liability. Then in the statement of financial position, we will basically show what? The right of use asset at the net book value, and number 2, the lease liability, which we must split into 2, the non-current and then the current. So what we need to do first of all, maybe we can depreciate, we can determine the depreciation of this asset. So what will be the depreciation of the right of use asset? The depreciation of the right of use asset. So the depreciation on the right of use asset, this one will be equal to the value for the right of use asset, this one, 56.75, 676. Then this will be depreciated over a period of how many years? This will be depreciated for the time the asset was leased. So if you go back to the information we have in paragraph 3, we are told Wingstone Limited immediately leased back the machine from 𝐻𝐶 for 5 years. So this one will be depreciated on straight line basis for the next 5 years. So what would be the depreciation per annum? The depreciation per annum here. The depreciation per annum will be 1135, 135. So that is the depreciation per what? Annum. So after doing that, we need to proceed and basically we amortize our lease liability. And actually we do that by preparing the amortization schedule. The amortization schedule. Amortization schedule. So this amortization schedule, we prepare it for how many years? I think for 2. Is it for 2 years? Yes, for 2 years. For 2 years. Because we must have the lease liability at the end of year 1, at the end of year 2. So we have the years here. Basically, the first year will end 31st of March 2018. The other year, 31st of March 2019 here. So we will have the lease liability at the start. Then the next column which follows basically depend with when this lease payment is paid. The lease payment as per paragraph 3, the lease payment is payable in arrears. So payable in arrears means that the lease payment is paid at the end of each year. So if that is the case, our next column here will be for the interest. We compute this interest based on the interest rate, that is the interest rate implicit in the lease. The interest rate implicit in the lease is given in paragraph 3, the last sentence, which is 4.625. So we compute that based on that rate there. Yes. So then we have the other column here for the cash to be paid. And finally, the lease liability at the end of the year. The lease liability at the end of the year. Yes. So the lease liability at the start of year 1, the lease liability at the start of year 1 is given as 8.4. Is 8.4. The lease liability, the present value of the lease payment, 8.4. 8.4. That is the amount we want to amortize. First of all, give me the interest here. The interest, 4.625% of this. I'm told it will give us 388,500. So the cash to be paid at the end of year 1 is basically the lease payment. How much lease payment will be paid at the end of year 1 is 1,920,000. Whatever you record here is what Wavestone will be paying as a result of having leased the asset, 1,920,000. So to get the lease liability here, we take the lease liability at the start, this one. We add the interest, and then we less the cash paid. So this one will be equal to A plus B minus what? Minus C. Minus C. Minus what? AC. Which I'm told will be 68,500. 68,500. So that now will be the opening lease liability here at the end of the following financial year. 68,500. We compute the interest as 4.625% of this, which will give us 317,668. 317,668. Then the cash to be paid remain the same, 1920. 1920, like that. What about the lease liability at the end of year 2? This one is 52,66,168. And I hope you're trying to confirm those values. Are you getting the same values, Frida? Are you getting the same figures, Georgina here? Are you getting the same figures, Mike? So please confirm whether you're getting the same values. Josephine, Mercy, are you getting the same value, Miriam? Are you getting the same value, Steve? Yes, yes. Okay, so now having this, we can be able to answer our questions. And what we are required to do is we prepare financial statement extract. So we will start by preparing the income statement extract, or basically the statement of profit or loss extract for the year which ended 31st of March 2018. So what we need to do here is basically to show what was supposed to be recognized in the income statement of this company. I've said two items of expenses, this depreciation and also this expense, this interest expense. So two items basically are the expenses. So the first one is the depreciation on the right of use asset. So which is this one, 1135,135. And then also we have the interest. And this interest, basically, this one will be taken to the income statement as part of the finance cost. So finance cost of what? Of this one. That is 388,500. Yes. So that what was supposed to be recognized in the income statement. What about the statement of financial position? Statement of financial position. Equally, here we have a number of items. Basically, for the year which ended 31st of March 2018. 2 items, or actually 3 items. So first of all, under the non-current assets, our company will recognize something called the right of use asset. Under the non-current assets, we have the right of use assets, and the right of use asset here will be recognized here at the net book value. What will be the net book value? The net book value will be the value for the right of use asset, which we computed here, 56, 75, 676 minus the depreciation for that year, which is 11, 35, and 35. So that will be the value for the right of use asset. The value for the right of use asset, the value for the right of use asset 45, 40, 1 word, that is 541. 541. Then our company will also recognize the lease liability here, but now the lease liability recall, we must split this into 2 components, the non-current liability and the current what? Liability. So we said the amount to be recognized here as a non-current liability at the end of year 1 should be the lease liability at the end of year 2. That one is recognized as a non-current liability in the first year. Then the difference between these 2 values, we recognize it here as what? As a current liability. So therefore, under the non-current liabilities, we will have the lease liability. We will have the lease liability. The lease liability. And basically, the lease liability at the end of year 1 here will be this amount here. The lease liability at the end of year 2. So which is the 52, 66, 1 word, 168, 168. Then from there, we determine the amount to be recognized as what? As a current liability. As a current what? As a current liability. The amount to be recognized as a current liability, we can just record it here. So under the current liabilities, still we will have what? We will still have the lease liability. The lease liability, and the lease liability should be the difference between these 2. So that decrease basically shows the amount which was payable within the next 1 year. The amount payable within the next 1 year. The amount payable within 1 year, which is 1602. 1602,332. 1602, 332. Yes. So basically, that is it. That what is required as far as that question is concerned. A very, very good question. A very, very good question on what is known as the sales leaseback transaction. Sales leaseback what? Transaction. If basically compare what you have done here, you'll be able to see the same concept, or actually the same thing they did in the other question, which I think was in your paper. There was a similar question in your paper. I think, was it around 2021? Yes, I think it was a question which was examined in 2021. Yes. So I think that is it. So what you'll do, can you try to revise on the other areas of leases, how the leases are accounted for by the owner of the asset, that is the lessor, and equally how the leases are accounted for by the lessee. How does the lessee determine the right of use asset? How the lessee does determine the lease liability? And also try to look on the 2 questions we did. We looked on a question whereby the lease payment, the minimum lease payment are payable at the start of the year and also are payable at the end of the year, because we said in terms of how we compute the right of use asset, the lease liability in those 2 instances is actually different. Such that if you happen to come across a question from this area here of leases, then we'll be in a position to comfortably handle that particular question. Yes. So for today, once we stop at that particular point, We stop at that point. So I think maybe what we will do once we meet on Saturday, we will try to revise on reconstruction. Majorly we said what maybe we will revise on is the internal reconstruction. But there was a question, I think, on merger. I don't know whether I will be able to show you the shortcut for handling that question. The shortcut for handling that question, because you never know. They may bring a question on merger, taking into account the question which is there sitting. It was a question on external reconstruction. Maybe I'll try to show you how we do those particular questions for external reconstruction, basically merger, using a shortcut, and then look on a question on internal what? Reconstruction. So therefore, before you meet on Saturday, basically try to look on that. External reconstruction, internal reconstruction, we revise that on Saturday, and then we say next week we go back to the topic of group account. We go back to the topic of group account. Yes. So for today, therefore, we are going to stop at that point. I don't know whether there is any question. Any question before we wind up? We have any question before we wind up? Any question before we wind up? Okay, so I think there is none. So let's stop at that point for now. Have a good night. We continue from there on Saturday.
The countdown to the August 2020.
Break-even sales. So the break-even sales, I've said in other terms, it is the break-even point in shillings. How do we compute the break-even point in shillings? We take the fixed cost, which is basically represented by capital F, and basically we divide that with what? With the contribution margin sales ratio. Now, I'm saying from that particular information, basically in the last paragraph, we already have this one. We have the contribution sales ratio. And actually, I've said the contribution sales ratio is the same with the contribution margin sales ratio. So basically, which is 50%. Now, this one, we can use it in terms of computing something called the contribution. Something called what? The contribution. Something called the contribution. And I hope you can be able to remember what is the contribution. Contribution basically is equal to the sales minus the variable cost. Minus the variable cost. Now, using the information which you're given here, how do we compute this one? The contribution will be computed as the 50% because this is now the contribution sales ratio. So it basically means that the contribution is equal to 50% of the sales. 50% of what? Of the sales, or basically 50% of what? Of the revenue. That's what you mean by the contribution sales ratio. The contribution is 50% of the sales, or basically that of the revenue. So in our case, how do we compute this contribution? We will take 50% of the revenue. So in our case, the revenue is given as what? A 60 million. So therefore, the contribution will be equal to that million. Will be equal to that what? Million. So having this contribution, we also know that to get the profit, basically we take something called the contribution margin, and I hope you can be able to recall this. We multiply that with X. And basically we get something called the fixed cost. The fixed what? Cost. I hope you can remember that formula. Now, this profit will therefore be equal to, in our case, what we have here, 30 million. This is the total contribution. And actually, this is the contribution in what? In shillings. So in arriving at this particular figure here, we take the contribution margin per unit. contribution margin per unit, we multiply that with what? With X. So in our case, this has already been computed for us, or basically we already have this figure, which is 30 million. So 30 million. So to that, what do? We less the fixed cost. And actually the fixed cost is what is missing here, because we already have the profit. I hope you can see we have the profit in our questions here. Our profit is basically 12 million. We have the profit, 12 million. We have the total contribution. And what is missing is the fixed what? Cost. Remember that what we want to determine here, so that we can be able to determine the break-even point sales, or the break-even point in what? In shillings. So what will be the fixed cost? We combine the right terms. So we bring the fixed cost to the other side, which now will be a positive, and then we will be left with 30 million. We bring this to the other side, which will be minus 12 what? Million. So meaning that the fixed cost in our case is 18 what? Million. So having the fixed cost, then we can be able to proceed and we compute the break-even point in shillings, or the break-even point in what? The break-even point sales. So the break-even point sales, or basically the break-even point in shillings, will be equal to the fixed cost, 18 million, this one. We divide that with what? The contribution margin sales ratio. I've said the contribution margin sales ratio is what we have here, 0.5. And this will give us what? This will give us a break-even point in shillings of how much? Of how much? Of how much? What are you getting here? Yes, I'm told by Virginia. This will give us an amount of 36 million. That will give us 36 what? 36 million. So at the break-even point, or at this particular point here, or once the company makes sales of 36 million, so basically the company will make what? Will make zero profit. So therefore, that basically what you just needed to know, that anytime you're given the contribution to sales, or actually once you're given the contribution sales ratio, that will help you in terms of computing what? The contribution. So the contribution will be equal to the 50% of the revenue, or 50% of what? Of the sales. Now, having the contribution, you can proceed and basically compute the fixed cost, because we know to compute the profit, we take the contribution minus the fixed cost. We already have the profit, 12 million. We have the total contribution, 30 million. What is missing is the fixed what? Cost. That's why we have been able to compute our fixed cost as what? Is 18 million. So having that, let's move to Roman 2 of the question. And basically what you're required to compute is the margin of what? The margin of safety. The margin of safety, that is MOS. And I hope you can also be able to recall that we compute the margin of safety as the difference between the current sales and the break-even point. And the break-even what? Point. So therefore, to compute this one, the margin of safety, we will take the current sales, basically in shillings, and then to this we less the break-even point in what? In shillings. So our current sales, currently our company is making sales of what? Of 60 million, and the break-even point in shillings is basically what you have computed here. That is what? 36. So the or the margin of safety in our case will be 24 million. So what does that mean? The margin of safety, it basically means that if the current sales of the company reduces with 24 million, the company will start making losses. The company will start making what? Losses. And equally, remember, we say that this particular margin of safety can also be computed as a percentage. How do we compute the margin of safety as a percentage? The margin of safety as a percentage is equal to the current sales. Current sales, basically in shillings. We deduct the break-even point in shillings, and then we divide all this with what? With the current sales. With the current sales still in what? In shillings. So therefore, our margin of safety as a percentage will be equal to this minus this, which is basically 60M minus 36M. We divide all that we divide all that with the current sales in shillings 60. And remember, because we want to express this as a percentage, we must multiply that with what? With 100%. With 100%. With 100 what? Percent. With 100%. Yes, so that will give us what? That will give us what? Yes, I'm told that this one will give us what? This one will give us 40%. That will give us 40 what? 40%. That will give us 40%. So basically, that is what is required in that question. Is a small one, but basically a tricky one. A tricky question. A tricky question. Now, I want us to look on. There is another question here for break-even, and I feel it is also important we do it. Can we go to the stitching for April 2024? Let's go to the stitching for April 2024. Question number 3B. April 2024. April 2024. April 2024, question 3B. April 2023, question 3B. Yes, I hope you are there. I hope you are there. I hope you are there. Okay. And so what are we told here? What are we told? Part B, it reads, luxury weekend county park is an entertainment park that offers individual and family entry tickets. So we are told that tickets include meals, 3 types of beverages, and unlimited use of a swimming pool. Luxury Weekend County Park has the following ticket prices and variable cost for the year 2024. So basically, we are told this is an entertainment park, which is called Luxury Weekend County Park. So it basically has 3 tickets. So the first ticket is called the individual ticket, the family ticket, and also I think we're given the total information. So we're given the selling price of each ticket and the variable cost, which include the cost of meal, the direct labor, the variable cost of beverages, the swimming cost, and then we have the contribution, which is the difference between the selling price and the variable cost. We have the apportioned fixed costs, and these are basically the fixed costs which are apportioned to each of the tickets there, equally the total, and then we have the expected ticket to be sold there. So then we are told, we're given some additional information. We are told, assume all the costs, assume all the assumptions of the cost, volume, profit, CVP, analysis are valid. And then number 2, we are told the sales mix is currently generated by 2 types of tickets in the following proportion. So individual ticket 60% and family ticket 40%. Though even if those particular current sales mix are not given, we can be able to compute that from the expected ticket to be sold. Expected ticket to be sold, because basically what you're given in number 2, those are basically the weight of each ticket, the weight of each what ticket. In other terms, these are like the product of this what, the product of this entertainment park. So, for example, for you to compute the weight of the first ticket, which is individual, you will take the expected ticket to be sold, which are basically 6,000, and then you multiply that. So you divide that with the total expected ticket to be sold for individual and also the family ticket, and then you multiply that with what? With 100. So automatically, this one will give us 60%. In other terms, the weight of this The weight of this ticket, the weight of individual tickets will be 0.6. What about the weight for the other ticket, which is basically the family ticket? So we can talk of WF, that is the weight of family ticket. So we will take the number of tickets expected to be sold, 4,000, divided by the total tickets. We multiply that with what? With 100. That will give us 40%, and therefore the weight here is 0.4. So we have that. So what are we required to do here? Roman 1, we're required to compute the weighted average contribution margin at the current sales mix assumed above. So we will start with that Roman 1 of that question, whereby we are required to compute the weighted average contribution margin at the current sales mix, at the current sales mix. So we say the computation of this is basically quite simple. If you can remember what we did in the other question, there is another question which we did on Sunday. So in this case, we can have the two product or the two tickets of this entertainment park. We have the individual ticket, and then we have the family ticket. Now, for us to be able to compute what is required here, there is something we need to have here. One, we need to have the contribution per ticket, and basically what? And the weight. That is basically what we need to have. So in our case, we already have the contribution. The contribution for the first ticket, which is basically below paragraph 1, the selling price minus the variable cost is 600. So then the contribution for this other ticket is 1,100. Then do we have the weight? Yes. The weight is what we have here, 0.6 and 0.4. 0.6 and 0.4. So that's basically what we have. And then from there, we can proceed and we compute what we are required. We are required to compute the weighted average contribution margin. How do we compute this one? To compute this one, we will take the contribution margin of the first ticket. We can just use I for individual ticket, the contribution margin for individual ticket. We multiply that with the weight of individual ticket, and then to this we add the contribution margin of the family ticket multiplied by the weight of the family ticket, like that. Okay, so we take this one, that is 600 times the weight, which is 0.6, and then to this we add the contribution margin of the family ticket, 1,100, times the weight of the family ticket, which is 0.4. So this will give us what? This will give us 360. 360. What about this one? It will give us for 40. It will give us for 40. And the total amount here, we get what? We get weighted average contribution margin of how much? Of 800, like that. Yes. Yes, so that's basically what we have. So let's move to Roman 2 of the question. In Roman 2, we are required to compute the total number of tickets that luxury weekend counterpart must sell to break even. So the number of tickets to be sold to break even. So the break even in what? In units. So remember, in this case, the units are basically what? Are tickets. So how do we compute this one? We compute this one basically by taking what? By taking the fixed cost, which is represented by capital F. We divide that with the weighted average contribution margin. And then, remember, in this case, what we are required to compute here are the total number of tickets to be sold, not basically the total individual tickets, not the total family ticket to be sold, but a combination a combination of the total tickets to be sold by this entertainment park for it to be able to do what? To break even. That's why you can see here we are using what? The weighted average contribution margin. So equally the fixed cost, we will use the fixed cost of the whole what? The whole entity or the whole company. And I think we have that below where we have the contribution margin. Below the contribution margin, I hope you can see we are given the apportioned fixed cost. This is the fixed cost apportioned to each product. But are we interested with that? No. What we are interested with, we're interested with the total fixed cost of this entertainment park, which is 7.5. We divide that with the weighted average contribution margin, which is 800, what basically we have computed up here. So, and this now will give us the what? Will give us the total tickets to be sold, including family and the individual tickets to break even. So this will give us what? This will give us what? This will give us 75 tickets. Yes. So those are basically the total number of tickets to be sold. And I'll say that this includes both the individual and also the family what? Ticket, the individual and the family ticket. So let's move to the other part of the question, which is basically Roman 3. And remember, in this case, we said even before we move to Roman 3, remember you say that you can be able now to split this, or basically from these total tickets, you can be able to determine the individual ticket to be sold, the family ticket to be sold. So you just use the weight here, this weight. So because now this 60% will be the family individual tickets, and 40% will be the family what? Tickets. But in our case, that is not what was required. We were required to compute the total tickets, including family and individual tickets to be sold to break even. So Roman 3, that is, we are required to compute the margin of safety in units. Remember, units here are tickets. For luxury weekend county park. So margin of safety, this one is equal to the current what? To the current sales, basically in this case in units. So how many tickets is the luxury weekend county park expecting to sell? So the expected, that is the expected or the budgeted sales in units minus the break-even point in what? In units. Remember that in our case, we have said units and tickets. So if you go back to the information we have below the fixed cost, we are given the expected ticket to be sold. So what we will do, we will take the total expected or the total tickets expected to be sold both for family and individual tickets. And basically that is total of 10,000. So this entertainment park currently is expecting to sell 10,000 tickets. So we less the break-even point. The break-even point is 93.75 tickets. So the difference now will be the margin of safety, which will be 625 tickets. So mean that if, for example, the current sales, the expected sales, we reduce with the 625, this entertainment park, automatically it will start making what? Losses. Yes. So let's move to the last part of that particular question, Roman 4. And basically what you're required to do is to calculate the number of individual tickets and the number of, that is, calculate the number of individual tickets and number of family tickets that luxury weekend county park must sell to break even. So I think that one is quite simple. Number of what? Number of family. That is, we can start with the individual. Number of individual and family tickets. To be sold to be sold to do what? To break even. To break even. To break even. To break even. So there are two approaches we can use in terms of computing these two approaches. One, we can take this total ticket to be sold for both family and individual, and actually we use now the weight, and we compute the number of individual family ticket to be sold, the number of family ticket to be sold to break even. Alternatively, now we can compute the break even point for individual ticket and family ticket using this particular formula here. So where we will take the fixed cost of each ticket, we divide that with the contribution of individual tickets. Maybe let's see whether if we use the two approaches, we are going to get the same answer. So we will take these total units, which are 9375 tickets, and basically you say that these are the total family and individual tickets to be sold to break even. So I'll say that we can apply the weight to determine the individual and family ticket to be sold. So the weight for individual ticket is 60%. So the individual tickets to be sold will be 60% of this. 60% of 9375. And that will give us how many individual tickets? How many individual tickets will be sold in order to break even? How many individual tickets would be sold in order to break even? Yes, so this one would be 5625 tickets. What about the family tickets? The family. So for family, we will take the weight. We will take the weight, which is basically 40% times 9375. And this will give us what? Will give us 750 tickets. 750 tickets. So equally, I've said there is still another approach we can use. We can use this formula, the break-even point in units, where we will take the fixed cost of individual tickets. We divide that now with the contribution margin, not with the weighted, but the contribution margin for each. So maybe we can start with the individual tickets here. So individual tickets. So for the individual ticket, we will take their portioned fixed cost. Their portion fixed cost is given as what? Their portion fixed cost is given as 3375. So out of this total fixed cost of 7.5, the amount which has been apportioned to this ticket is 75,000. And then we divide that with the contribution margin. The contribution margin for individual tickets, this one, 600. So this should give us the same answer here, 5625 tickets. Are you getting the same answer? 5625. Yes, 5625. So we do the same for the family ticket. For the family ticket, we take the apportioned fixed cost. The apportioned fixed cost is 4125,000. We divide that with the contribution margin, this one, 1100. So that equally should give us 750 tickets. That is 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 750 tickets. Are you getting that? Yes. Yes. So therefore, basically that's what was required as far as that question is concerned. Basically, a computation of the margin of safety and also the break-even point. So the marks allocated there were two there, a total of 8 marks. A total of 8 marks. I don't know whether we did we tackle that part C of that question in class? Did we tackle part C of that question in class? Did we tackle part C of that question in class? Or we can just do it? I think it is in relation to break even. It is in relation to, I think, what is it? Something to do with the EOQ and so on. Did you handle that question in class, or we can just do it? Tulifanya ama tuifanye tu? Did you handle that question in class? So we did it, eh? Ida? We did it in class, eh? Okay. So I think if we did it in class, no need of repetition. No need of repeating it. No need of repeating it. No need of repeating that questions there. No need of repeating it. Okay. Yes, so I think maybe you can just, let's just take a short break of 10 minutes. We come back. I get like 2 other questions, which we are going to do. And maybe you can confirm for me, I don't know whether you can be able to confirm for me very fast. Which questions did we tackle on preparation of income statement using marginal and absorption costing? I think we did like 2 questions in class. 2 questions in class on preparation of a profit statement using the marginal and also absorption costing. Marginal and absorption costing, we did 2 questions. We did 2 questions in class, if I'm not wrong. I think we did 2 questions. Is that the position? We did April 2023. We did April 2023. Which other one? Which other one? What about December 2024? I think we also did that one. Eh? Yes, December 2024. So we did 2. Eh? We did 2 or 3. Okay, so I think we did 2. Eh? Okay, so let's just take a short break of 10 minutes. We come back and then I'll get another question.